Hi there everybody and welcome to another stock analysis video. We are going to be analyzing today a second company, Medtronic. Again, they have their earnings coming out before market open, and I want to analyze this company to see what we can say about their fundamentals and whether or not we should buy it. So with that said, let's get started with this analysis. Starting off, guys, Medtronic is a really liked company for a lot of people, especially those who invest for their dividend. And as you can see right here, they have a dividend yield of 2.51%, which ends up being 63 cents a share for an annual payout of $2.52. Payout ratio in regards to their net income is around 43.4%, which is really good. However, we're going to take a look at this in regards to the free cash flow. 5-year growth rate on this dividend is pretty decent at 8.14%. They have increased their dividend for about 8 consecutive years. Their ex-dividend date unfortunately was December 21st. Their payout date was January 14th, and they pay their dividends quarterly. Now coming over here to the spreadsheet, we got the ticker symbol MDT for Medtronic, market cap of $135 billion, PE of 28.96. So this is already telling me that at $100 a share, this PE is pretty high. This is one metric, and for this is only telling me that this company might need to fall a decent amount to fall under the PE of 20. However, one metric doesn't necessarily cut it. Now take a look at others and then come up with their own target share prices. And as we saw, they do pay a dividend of $2.52, and this actually comes out to be $3.4 billion being paid out every single year in dividends. And after this is paid, they're still left with around $2 billion in their 5-year average free cash flow. And unfortunately, even though their payout ratio in regards to their net income is 43%, their payout ratio in regards to the cash flow is 65%, which is a little bit higher than what I normally like. In fact, this is beyond my plus or minus 5% that I would accommodate for the 60% cutoff. So right then and there, I'm kind of a little bit worried about this. Mainly because of the fact that if this 5-year average free cash flow was significantly higher, then I really wouldn't care, since they would still have a lot more of their free cash flow, even though it is 65%. Now coming over here to the fundamentals, we got the net income 5 years ago of $4 billion to 1 year ago of $3.6 billion, which is, unfortunately guys, it is a decrease of around 10%. Now, this is not something that you want to see. This is pretty much stagnant, and I'm not really a fan of this. 2 years ago and 3 years ago, they did have a pretty good year. However, last year, they just completely went down. In fact, they pretty much did the same as they did 4 years ago. I'm not necessarily liking this, even though the trend line is going up from the 5 year ago to the 1 year ago, it is going down, and to me, this is a flat line. Next, we got the free cash flow 5 years ago of $5.6 billion to 1 year ago of $5 billion, which unfortunately it is a decrease of 13%, with an average 5-year free cash flow of $5.2 billion. And just like we saw with the net income, we see something very similar here. 2 years ago and 3 years ago, they did pretty decently. 5 years ago, they did pretty decently as well. And then 4 years ago and then 1 year ago, they just slightly went down. And just as we saw with the net income, this is also a negative metric from the 5 year ago to the 1 year ago. And even though the trend line is slightly going up, to me, the way that I see this is once again a flat line. Next, we got the revenue 5 years ago of $29.7 billion to 1 year ago of $30 billion, which is a very slight increase, guys, of 1.37%. And even though this one, it is a positive metric, unlike the other two, this is still a flat line, as y'all can see, maybe slightly going down, and 1.37% doesn't necessarily cut it for me. In fact, look at the 2 year ago, they did $28.9 billion, and then last year, they slightly increased to $30.1 billion. So there really is not much difference. In my opinion, their revenue is essentially flat within the past 5 years. Now let's actually take a look at the total assets minus the total liabilities. This tells you whether or not the company is able to cover all of their debts. Currently, Medtronic has around $15 billion. This means that if they were to liquidate all of their assets and pay off all their liabilities, they would still be left with around $15 billion. And actually, something to note here, the fact that they are positive this current year, very good. And not just that, they have been positive for the past 5 years by a significant amount. 2 years ago, they had a slight decrease. However, it wasn't enough to make me worried at all. I mean, they still had left $11.7 billion. So we're still good when it comes to this. They're 100% able to cover all of their liabilities. Average total assets is around 24 billion. Average total liabilities is around 9 billion. And average assets minus the average liabilities is $14.7 billion. Now coming over here to the silent killer when it comes to investing, the shares outstanding. You want this number to be going down. The more this number goes up, the more the company is diluting you as an investor. You do not want this. And well, actually, Medtronic's actually doing a pretty decent job right here. They are buying back shares, not by a huge amount, but they are buying back shares nonetheless. 5 years ago of 1.4 billion to today of 1.3 billion, which is a decrease around 1.79% on the 5-year. And from the previous to the current year, they have bought back around 1/3%. So even though to me this isn't really a huge decrease, I would like to see a lot more. It is a decrease nonetheless and a positive metric. And lastly, we got the cash and equivalents. And as of today, they have around $2.9 billion in cash and equivalents with an average cash and equivalents of $3.9 billion. Now let's make some assumptions, guys. Let's make a low, median, and high assumption. And I'm going to be using 3 different factors: growth, projected share buyback, and required rate of return. The required rate of return, I'm going to keep it the same across all assumptions, 10% to match the S&P 500. And I'm going to be changing the growth and projected share buyback based on what Seeking Alpha says, the revenue growth year over year, and the revenue growth forward is. And the projected share buyback, I am essentially going to be winging it and using the projected share buybacks that we just saw in order to make a similar assumption. So for the low assumption, I'm going to say a growth of 2% with a 0% share buyback, meaning that they will not buy back shares within the next 3 to 4 years. They're going to keep it at 0. They're going to keep it the same shares that they have currently right now. And this comes out to be a target share price not adjusting for debt of $52.39. For the median assumption, I'm going to say a growth of 4%, and let's say that they buy back shares at around 1%, which is what they have been doing recently. And this comes out to be a target share price of $57.91. And for the high assumption, let's say that they manage to grow at 6% and buy back shares at around 2%. This comes out to be a target share price of $63.98. Now we need to adjust for debt. In doing so, this number comes down, meaning that they have a lot more debt than they have cash, meaning that their net debt is significantly higher than the cash that they have on hand. Therefore, for the low assumption, we would like to buy at $41.33. For the median assumption, we would like to buy at $46.52, and for the high assumption, we would like to buy at $52.23. Now adding a margin of safety of 5, 10, and 15%, just so that way we had a cushion, and this also gives you much more returns, because the more that you pay for something today, the less returns you're going to have in the future. Therefore, for the low assumption, we would like to buy between $35 and $39. For the median assumption, we would like to buy between $39 and $44. And for the high assumption, we would like to buy between $44 and $49. Guys, the current share price is $100.58. So all of my assumptions right here, assuming that they are correct or in the correct ballpark, is telling me that this needs to drop by around $50, even for the median assumption. For the high assumption, not adjusting for debt, this would have to fall around $40. Therefore, the way that I'm looking at it is this needs to drop, and actually this justifies the PE being the way that it is. But then again, guys, this is my assumptions. If you do not believe me, then by all means, I have this calculator available. Anybody can use it. I have it in my discounted free cash flow calculator video. Just look it up on my channel, the updated one. And you can have this calculator. Just make a copy of it and then just follow the video so that way you know what to put. This way, you can make your own assumptions, because at the end of the day, every investment is the present value of all future cash flow. I am not telling you what to buy. I'm not telling you what to put your money in. I am teaching you a process. That's all I'm doing. If you like my content, if you like the calculator, all I'm asking for, guys, is like, subscribe, comment, and share. That's about it. Hit the bell. Tell your friends. I love to grow my YouTube channels a little bit more. I want to grow this community out. I want more people to learn about this process, because a lot of people don't know how to use the process when it comes to investing. They just use it as gambling. I used to do that, and I lost $1,000 worth when I was like 20. I don't want people to lose money. I really, really don't. So that's why I'm trying to teach you guys a process. Therefore, all I'm asking for is like, subscribe, comment, and tell your friends. That's it. All in all, guys, when it comes to Medtronic, this is actually a company I did consider to buy for my dividend portfolio. However, looking at it now, with all of these flat metrics that they have had, I mean, net income, free cash flow, revenue, they're essentially all flat. It's not really that much of an interesting buy for me, honestly. They would have to increase their net income, their free cash flow, year over year for probably the next couple years in order for me to be excited about this. Because right now, at $100 a pop, this right here is not worth me buying. But at the end of the day, that's just my opinion. But that pretty much does it for this episode. Liked if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you will find exclusives as well. In regards to Rumble and YouTube, I have made a Let's Play channel called Fatal Plays, also link in the description, where I'm currently going through Pokemon Legends Arceus, so if you want to catch that, the link is in the description below. With that said, peace out, and be on the lookout for the next stock analysis video.